Two men, same job, same salary, same investment discipline. One retires at 55. The other works until 70. They went to the same college, joined the same fraternity, married women they met at school. They even became vice presidents at the same company. Neither had a working spouse, neither inherited money, neither ran a side hustle. So what created a 10+ year gap in retirement? Jim did what most disciplined investors do. He consistently bought the S&P 500 through an ETF like SPY. Over 20 years, he earned about 10% per year. Solid, proven, respectable. Steve also used ETFs. But Steve made one adjustment. He didn't try to pick stocks. He didn't trade every week. He simply rotated sectors based on where the economy was in the business cycle. Over the same 20 years, he compounded at over 14% per year. That difference, just 4 percentage points, is the difference between financial independence and another decade or more at your desk. What Steve was doing is called sector rotation investing. And it's not complicated. Sector rotation investing is exactly what it sounds like. You don't have to pick individual stocks. You're not trying to time the market to the day. You're watching broad economic signals and shifting your investments into the sectors that tend to do better in whatever phase of the business cycle we're in. That's it. Think of the S&P 500 not as one thing, but as 11 different neighborhoods. Some neighborhoods thrive when times are good. Others quietly hold their value when everything else is falling apart. Sector rotation is knowing which neighborhood to be in before the crowd figures it out. Buy and hold works. Nobody's arguing that. It's a perfectly reasonable approach. But here's the honest math. A reasonably well-executed sector rotation strategy can outperform buy and hold by meaningful margins. One sector rotation strategy has earned 17% annual gains over the last 25 years. During the 2009 to 2010 recovery, early rotation outperformed the market by 40 to 60%. That gap is exactly what you saw in Steve's account. Same discipline, same patience, different allocation logic, and he retires over a decade earlier. Here's where most people give up and say that sounds great for professionals. But you don't need a Bloomberg terminal. You only need to watch a few reliable business cycle indicators. Some professionals suggest watching just 5. First, the 2-year and 10-year Treasury bond yield curve. Under normal conditions, the 10-year rate is higher. An inversion when short-term rates rise above long-term rates has preceded most every recession in modern history. An inverted curve is your signal to rotate toward defensive sectors. When it starts normalizing, that's your early recovery cue. Next, the ISM Manufacturing PMI. This is a monthly number that tracks factory activity. Above 50 means expansion. Below 50 means contraction. When factories are busy, cyclical sectors follow. When activity slows, defensive sectors hold up. This number prints on the first business day of every month. You can look it up in 30 seconds. It's one of the cleanest real-time reads on where the economy actually is, not where analysts think it's going. Third is the Fed's monetary policy. One study published in the International Journal of Business and Social Research found that sector rotation strategies based specifically on interest rate adjustments can significantly improve portfolio performance. Lower rates generally lead to economic expansion. High rates can lead to a cooling economy. And here are 2 more that are consumer-focused. The unemployment rate trend, not the number itself, the direction. When unemployment is falling, the economy is expanding. When it starts ticking up from cycle lows, even slightly, contraction is usually already underway. By the time the Fed announces they're worried about jobs, the trend has been visible in the data for weeks. You don't have to wait for their press conference. The 5th is consumer confidence. Consumer spending makes up 70% of the economy after all. Elevated confidence points to early recovery or expansion. Reduced confidence can mean contraction or worse. This isn't 5 signals, it's one question. Where are we in the cycle? And to keep it manageable, focus on 4 phases of the business cycle. Contraction or recession needs no explanation. When unemployment is rising and the PMI drops below 50. Bonus points if the yield curve inverts. early recovery when the economy is bottoming out. The yield curve starts normalizing. PMI and consumer confidence begin climbing back up. Rates have been dropping. Expansion when we're running on all cylinders. PMI over 50. Consumer confidence is high, unemployment is declining. And the peak, late or post-expansion when growth starts slowing. PMI may start flattening or declining. Consumer confidence may wane. Rates may begin to rise. You don't need to monitor the indicators daily. A monthly check of the yield curve, the PMI reading, and the unemployment report is genuinely enough. These trends move slowly. That's actually the point. You have time to position, not react. Also, these signals tend to cluster. When the yield curve is inverted and the PMI is below 50 and unemployment is ticking up, that's not ambiguity, that's confirmation. You're not guessing. You're reading a pattern that has repeated across 7 decades of economic cycles. Now let's talk about which sectors to own in each phase. This is backed by nearly 70 years of data covering 7 recessions, 7 recoveries, and 12 expansions. During contraction, the 3 sectors that hold up are consumer staples, utilities, and healthcare. Consumer staples was the only sector to average a positive return across 6 of the last 7 recessions. People still buy toothpaste when they're scared. Utilities don't slow down because electricity bills don't stop arriving. Healthcare holds because people need hospitals regardless of what GDP is doing. Together, these 3 averaged returns roughly 10% higher than the broader market during recession periods. That's not a small edge. During early recovery, money starts rotating into financials, real estate, consumer discretionary, and industrials. When the yield curve steepens and credit conditions loosen, banks start making money again. Technology can often be a solid play too. Real estate is the most interesting one here. It's typically the worst performer during recessions, high sensitivity to income and employment. But when recovery arrives, it tends to be the biggest beneficiary. The sectors that fall the hardest often bounce the highest. During expansion, technology moves to the front. Tech loves low interest rates because cheap money reduces the cost of discounting future earnings. Industrials and materials join as the economy is running at full capacity and raw materials are in high demand. At the peak, energy does well as commodity prices crest. Healthcare can be a solid play as well. These are the sectors where Steve was positioned during each particular phase of the economic cycle. And it's a big part of why his account compounded faster than Jim's index fund over 2 decades. And you don't need to pick individual stocks to run this strategy. The Spider family of sector ETFs covers all 11 sectors. For instance, XLP for consumer staples, XLF for financials, XLY for consumer discretionary. Keep it to 1 rotation per phase transition. Low cost, no stock picking, no earnings calls to analyze. This is exactly what Steve was doing. Not trading every week, just repositioning when the macro signals shifted clearly enough to act on. Only you can decide if this fits your style. If you want fully passive investing, a simple index fund works and will serve you well. But if you're the kind of person who already pays attention to economic news, who notices when interest rates move or jobs numbers disappoint, you're already watching the signals. The only question is whether you're doing anything with them. Steve didn't overhaul his financial life to retire more than a decade ahead of his brother. He just learned to read the map, and once you see it, it's hard to unsee. If you like this video, subscribe. We publish fresh content weekly to help you protect and grow your wealth. Next, watch Is the US planning a $37 trillion crypto debt reset? It's on the screen. In the description, you'll find a link for 10% off alpha picks. They've significantly outperformed the S&P since 2022. You'll also see a link to my Wealth Builders Blueprint, where you can find a list of stock screeners and a link to Zach's Confidential, a stock recommendation newsletter with dual money-back guarantees. Finally, I listed several of the reference documents for this video in the description if you want to dive deeper. Thanks for watching. I'll see you on the next one.